Dividends over growth? Perhaps growth over dividends. The balance here is delicate. A portfolio of growth-oriented stocks can lead to great returns, but tends to be highly volatile. Some can bear that risk, others cannot. A dividend-heavy portfolio might pay you each month or quarter, but growth tends to lag the market, especially if chasing dividend yield. It's safer, but performance is still important. I believe there is a happy compromise, however. Stocks that are growth machines, yet pay a growing dividend. And today, I have 3 stocks that fit this mold. Welcome to the Quality Investor. Dividend yield has never impressed me as much as dividend growth. A high yield can be attractive, but remember, yield goes up when share price comes down. A red flag. While some businesses have attractive dividend yields and are high quality, businesses such as ExxonMobil, AbbVie, Chevron, and Johnson & Johnson, these businesses have 3% plus yields, but they're in industries that are highly cyclical, energy, or have high regulatory risk, pharmaceuticals. In my view, the yield you receive from these stocks don't justify the slow growth nature of these businesses. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. On top of that, each of these businesses, with the exception of AbbVie, have grown their dividends by less than 10% annually over the last 10 years. AbbVie, while their 10-year dividend CAGR is 14%, it has since slowed to just under 5% on a one-year basis. Check out the CAGR and some of the fundamental metrics over the last 3 years. Over the last 3 years, these businesses have not grown in a way that would be considered high growth. Chevron and ExxonMobil are the only businesses with over 7% revenue growth annually the last 3 years. AbbVie is essentially flat, and Johnson & Johnson is down, median of 3.5% revenue growth. Now, gross margin has grown slightly, a median gross margin growth here of 0.36% per year, but operating margin has also fallen a little bit, as has earnings per share. On a median basis, these businesses are down 1.7% earnings per share per year. And even worse, they have a declining free cash flow. Declining free cash flow is not a good sign if you're trying to grow your dividends. And you can see that they have median dividend growth of 5.7% per year over the last 3 years. And depending on the inflation number that you use, that's just barely staying ahead of inflation. These are popular stocks with the dividend crowd. But for me at least, it is very tough to sacrifice investment growth for dividend yield. And like I said, most high yield stocks are red flags. Dow Chemicals has a yield of 9.9% and is down nearly 30% year to date. Pfizer has a yield of 7.4% and is down over 10% year to date. And Walgreens, with a yield of 9%, was on the verge of bankruptcy before being bought out by private equity firm Sycamore Partners in March. These are businesses that do not inspire confidence. Growth is great, though. The best growth stocks have proven their business models and operate with a significant economic moat. The Magnificent Seven all come to mind, but others, such as Netflix, Costco, and Fair Isaac, have easily proven their worth. For me, however, I like to find the balance of high growth with a growing dividend. I believe these offer the best long-term value in terms of growth of the business, but also increasing dividends, especially at a pace faster than inflation. I'm going to look at 3 stocks today, one of which is in my portfolio, and I believe these stocks offer the best of both worlds. I looked at 3 basic criterion. First, they had to have at least 10 years of consecutive dividend increases. This demonstrates reliability. Second, they had to have at least a 10% 5-year CAGR for dividend growth. This shows they're increasing their dividend aggressively and recently. And third, they had to have reasonably low free cash flow payout ratios. This shows They are rewarding shareholders with dividend growth, but also reinvesting back into the business. The three businesses that are on this list today are MSCI, Lam Research, ticker LRCX, and MasterCard, ticker MA. Let's dive into it and look at their numbers. First, we're looking at MSCI, and they've had 10 consecutive years of dividend growth, which has been outstanding growth. You can see on a 10-year basis, its dividend has grown 43% per year, and on a one-year basis through fiscal year 2024, it's grown at 16%. At the end of this fiscal year of 2025, they will pay out a dividend of $7.20 per share, 12.5% growth over last year. Of course, to have strong dividend growth, you also need to have strong free cash flow growth. And you can see on a 10-year basis, their free cash flow has grown at 23.6% per year. And just last year, their free cash flow increased 21.6%. And of course, over the last 10 years, they have hovered around a 33% free cash flow payout ratio. You can see that free cash flow payout ratio has steadily increased a little bit, but it shouldn't be too much of an issue for them to continue to pay out their dividend, as this is a cash generating machine. MSCI has a free cash flow margin of nearly 50%, and with strong operating leverage over the next few years, we should expect to see that free cash flow margin continue to increase. They do have a yield right now of just over 1% at 1.3%. Next on this list, we're looking at Lam Research in the semiconductor equipment and materials industry. Lam Research is a supplier of wafer fabrication equipment. The company designs, manufactures, and markets semiconductor processing equipment used in the fabrication of integrated circuits. Its products are designed to help its customers build devices that are used in a variety of electronic products, including mobile phones, personal computers, servers, wearables, vehicles, and data storage devices. So it is a vital part of the semiconductor supply chain. They also have 10 years of consecutive dividend growth, which has also been very strong. On a 10-year basis, it's at 46%. In the last 1 year, it's at 15.9%. Their 2024 dividend was at 80 cents, and their dividend at the end of 2025 will be at 92 cents per share, growing at 15% this year. This is also a very low free cash flow payout business. Their 10-year average for free cash flow payouts at 24% per year. And you can see that low payout down here, a little bit cyclical due to the nature of the semiconductor industry, but with strong free cash flow growth at 27% per year over the last 10 years, Lam Research has no problem paying that dividend. And of course, with a healthy 20+% free cash flow margin, future dividend growth will remain safe. They currently pay a yield of 1.13% annually. And finally, we are looking at MasterCard, the second twin tower to Visa. Of course, many argue that MasterCard is the better business than Visa, with even better growth prospects going forward. MasterCard and Visa operate as a duopoly in the credit card payment processing business, and they're essentially a toll collector, and they have the margins to show it. MasterCard has 13 consecutive years of dividend growth. Their compound annual dividend growth rate over the last 15 years has been 28.7% per year, and in fiscal year 2024, they grew their dividend by 15.8%. The dividend that year was at $2.64. The dividend they're going to pay out in fiscal year 2025 is $3.04, with yet another year of 15% growth. And of course, MasterCard has no problem covering that dividend growth with stellar free cash flow growth on the last 15 years of 19.7% per year, and just last year, nearly 20% free cash flow growth in 1 year. And like I said, this is an incredibly profitable business with high operating leverage. MasterCard has a free cash flow margin of nearly 50%, just like MSCI. Of course, this strong growth of their stock has pushed their dividend yield down over the last 10 years, so they only pay a 0.54% dividend yield, which is the weakest among the dividend growth stocks we're looking at today. But with strong dividend growth, 15+% per year, and with a free cash flow payout percent over the last 10 years averaging at under 20% per year, MasterCard certainly has very much room to grow that dividend even faster. And if they're anything like Visa, they're going to engage in strong dividend growth and share buybacks. To conclude today's video, these are the 3-year compound averages of some of the fundamental metrics for these 3 businesses. Remember back these other 4 businesses I showed very slow growth. Well, MasterCard has 14% revenue growth over the last 3 years. Lam Research flat over the last 3 years, but they are due to bounce back this year with strong revenue growth as the semiconductor industry recovers from its typical cyclical trough. And MSCI, of course, grows like clockwork, nearly 10 to 12% per year. We've seen slight gross margin growth and operating margin growth, and we have strong earnings per share growth as well as free cash flow growth to support growing dividends of at least 15% per year on a median of these 3 companies. And because all of them generate such strong free cash flow margins, you can see on a median basis, these businesses have grown their free cash flow margin nearly 4% per year the last 3 years. That supports not just dividend growth, but share buybacks as well. So these are 3 strong businesses with strong futures ahead for not only dividend growth, but share appreciation as well. And each of these businesses has a very wide economic moat, which will ensure investors are very happy with the returns in the years to come.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.